You ever look at one of those professional stock reports and just wonder how on earth they come up with their conclusions? Well, today we're going to do exactly that. We're pulling back the curtain on a real analysis for a company called Prudent Corporate Advisory. Let's see how the sausage gets made. Okay, so right off the bat, no suspense. The analysts who put this together have a very clear opinion. They are stamping this one with a big, bold buy. But, a recommendation is just the headline. The real story is in the evidence that got them there. And they're not just being vague about it. They've put a number on it, a target price of 520 rupees per share. So it's not just a buy, it's a buy with a very specific destination in mind. This gives us something concrete to work with. And that is the million-dollar question, isn't it? This isn't about guesswork. It's a structured investigation. We're going to follow the trail the analysts left, from the big picture all the way down to the tiny details, to really understand their logic. So first things first, the analysts zoom way out. Before you can understand a single fish, you have to understand the ocean it's swimming in, right? For Prudent, that ocean is India's financial advisory industry. And here's the crucial first piece of evidence. Prudent isn't fighting against the current. The entire sector is booming. This is what investors call a tailwind. It's like a strong wind at your back, pushing the whole industry forward. So what exactly are these tailwinds? Well, the report points to a bunch of things. More companies are merging, regulations are becoming more business-friendly, and there's just a growing demand for expert financial advice. Each one of these trends is creating more business for companies just like Prudent. Okay, so the industry is strong. That's a great start. But what about Prudent itself? Now we zoom in from the ocean to the fish, and we're going to look at the hard numbers to check its vital signs. And that first vital sign, revenue, looks really healthy. The money coming in the door isn't just growing, it's accelerating. It's on track to more than double in just a handful of years. This is exactly the kind of powerful, consistent growth that gets analysts to sit up and take notice. Next up, the report checks the company's short-term health, what's called its liquidity. It's a pretty basic but super important question. If all your bills were due tomorrow, could you actually pay them? It's all about having cash on hand. And for Prudent, the answer is a big, resounding yes. Look at this. Across several different ways of measuring it, the current ratio, the quick ratio, the cash ratio, the grades are excellent, strong, and robust. This tells the analysts that the company has a very comfortable cash cushion. No short-term money worries here. So, after checking the short term, the analysis naturally moves on to the long term. Solvency is all about endurance. Can the company survive and thrive for years to come? And a huge piece of that puzzle is how much long-term debt it's carrying. And this is a massive green flag for the analysts. Prudent has very, very little debt, especially when you compare it to its competitors. Less debt just means less risk. It's kind of like you're running a marathon with a light backpack while everyone else is carrying heavy weights. It gives you a ton of flexibility and strength. Revenue is awesome, but it's really only half the story. The next critical question is the company actually profitable? How much of that growing revenue is actually sticking around as profit? It's the difference between just making sales and actually making money. And wow, the report's findings here are stellar. A net profit margin of over 42% is just exceptionally high. Think about it. For every 100 rupees of revenue, more than 42 of them are kept as pure profit. And the report makes a point to say these numbers aren't just good, they're getting better, and they're leading the entire industry. So we've seen these fantastic financial numbers. But why are they so good? What's the secret sauce? Well, the answer lies in the company's fundamental business model. First, let's just quickly look at what Prudent actually does. They make their money by providing expert advice on business deals, managing wealth, and corporate finance. Notice what's missing. They don't sell physical products. They sell knowledge and expertise. And that's the core of what they call their asset-light model. Since Prudent sells services, they don't need giant factories or expensive equipment. This keeps their costs way down, which is exactly why those profit margins are so high. This model is the engine driving those amazing financials we just looked at. And the report also identifies how Prudent protects this profitable little setup. They don't try to be everything to everyone. They focus on a specific niche, the mid-market, where they've built deep relationships and tons of expertise. It's not just what they do, it's that they've carved out a space for themselves that's hard for others to attack. Okay, we've seen the strong industry, the fantastic financials, and the smart business model. Now for the final piece of the puzzle.
How do the analysts take all this evidence and translate it into that specific target price?
They do it by running different scenarios. They ask, okay, what if things go kind of poorly? That's the bear case. What if things go amazing? That's the bull case. And what's the most likely middle-of-the-road outcome? Well, that's the base case, and that's where our target price comes from. And that brings us right back to where we started, the final verdict. The big difference is, it's not just a headline anymore. Now we understand the why behind the buy rating, the 520 rupee target, and even that moderate risk level. We follow the entire chain of logic from start to finish. And this quote from the report's conclusion really just sums it all up perfectly, doesn't it? The analysts see a company with a super strong foundation, in a growing industry, trading at a price that they believe is pretty reasonable. So, we've broken down the how and the why of a professional stock analysis. The logic is clear, the evidence is all laid out. But, as the report itself would tell you, any analysis is a look into a possible future, not a crystal ball. But the crucial thing is, now you have the tools to understand the argument being made.